Two. Welcome back, everybody, to the newest episode of the Getting Real podcast. I'm your host, Matt Harms, founder and principal owner of the Time Away Realty Group and the host of the Getting Real podcast. Today, I have the pleasure of being joined by a 1031 exchange expert, Doug Blackwell. How are you today, Doug?
Fantastic. Couldn't be better.
I am so glad that you're here. I have to tell you, even in my extensive real estate career, it's not easy to find folks with the 1031 experience you bring to the table.
Well, I appreciate that.
My pleasure.
So what's interesting about that, though, is that this is all I've been doing for 22 years. And there's not many people that do what we do because they don't it's a niche business and it's a passion. So it's not many people, like I said, not many people do it, but I love doing it. So
I have to tell you, I've been, unfortunately, not my own deals, but I've been a part of firms where deals have closed and people are asking after the fact. So about that 1031 exchange, and the lawyer's like, no one told us up front we were 1031ing this money. So you're out of luck.
absolutely correct. And that's the sad thing, Matt, is that, I find out so many times at the close table from an escrow officer somewhere in the country doing a closing, they reach across and hand the seller the check and say, congratulations. And they go, yeah, but I got to pay a lot of tax. And the escrow officer looks at him and says, had you not considered a 1031 exchange? And they look at the escrow officer really puzzled, and they say, what's that? And they get rather upset. They paid a lot of people a lot of money to have their back, and not that anybody could be sued for not telling them, but it really wrecks a good relationship.
Oh, absolutely. I mean, in any aspect of a real estate transaction, not that you can pinpoint whose responsibility asking that question should be. But if you're helping someone sell a home as a realtor and you're getting a sizable 2 to 6% of their money, the attorney's collecting their fee, the escrow agent's collecting their fee, the title company's collecting their fee, and no one once said, what's the seller's intention for these funds?
Well, as you know, a 1031 exchange, my job is on investment real estate is what I work with, and it's highly appreciated real estate, which most of it is these days. Obviously, people make most of their money in real estate. And my job is to say, okay, if you want to do a 1031 exchange, we have to know before the close, like you said, and we could structure the deal so that the client, they can't touch the money is the trick. And the money has to be transferred by a third party or qualified intermediary, such as myself. And we transfer that funds to the purchase property they want to buy. There's some rules and things we got to follow doing it, but in essence, the client gets to keep all of the money from the sale. No taxes are due today. We defer everything into a new property, allowing it all to go back to work for them if they follow a few simple rules. And we're not going to have time to really go into a lot of those rules today, but most of my clients are happy when they can say they don't have to pay the tax today. And the back end of it, though, I want to make sure everybody understands, they're thinking they may have to pay the tax someday. Not necessarily, because if you plan your estate correctly, the estate will take care of the tax liabilities I'm deferring. So quite possibly your family can receive the entire value of the property without any tax due on it, except for the estate taxes that might be lingering. It's amazing what I've been doing. So.
Yeah, no, I mean, when I first got into real estate, 20 years ago, I probably hadn't heard the term 1031 for the first 5 or 10 years of it. And I mean, it's such a powerful tool. I think really where we should start for anyone out there who has not heard the term and they're sitting here going, what are you guys talking about? What exactly is a 1031 exchange?
So it's for properties you held for investment, for not fix and flips and not for things you're living in personally as your personal home or your vacation home you're using personally. It's for your investment property, things that you've either converted to investment, never lived in personally, but have held for growth, land, for example. And you're going to buy new property also to be held for investment or productive use in a trade or business. And on that sale, when you do the transaction, the qualified intermediary steps in as myself, and we help the transaction and receive the proceeds. We take those proceeds, and by the client's direction, we move those towards what they want to purchase for this transaction, which also, as I said, be another piece of investment real estate. But the beautiful thing about it is you get to defer the tax. You get to keep all the money. So that's what we're doing. That's the most important thing I can tell you.
So, I mean, I know me personally, I hear defer the tax, save the tax. It's like, okay, that's great. But just to put in perspective for anyone listening who might be curious as to how substantial that could be, if you'll humor me, let me give you a quick scenario. And no one here is an accountant. I give my disclaimer. Maybe you are, but this is not tax advice. But let's just
Thank
say
you.
I've sold an investment property I've owned for 30 years. I'm walking away with $1 million. That
Okay.
property's been fully depreciated already, right? After the 23, 27 and a half, whatever the IRS allows. So if I'm in a 30% tax bracket, I'm going to pay 30 roughly percent of that $1 million in capital gains tax, right?
Well, roughly, depending on the state you are in, you get state and federal, plus local taxes and depreciation or capture, plus net investment income taxes. It could be really brutal.
So my $1 million could look more like 500,000 when I'm all said and done at the table.
At worst case scenario, but 600 is not unlikely. So it's bad enough. So
Okay. So now that we have some numbers in mind, you step in and you say, hey, Matt, why would you do something like that? What are your plans for the money? Well, I don't know. I just wanted to get rid of this property. Someone made me an offer I can't refuse. What is the next step when you come in to tell me before I sign those closing documents?
gotcha. So I always want to make sure that doing a 1031 exchange makes sense for a client. There'll be a few questions about what you paid for it, finding that basis number we talked about, and how much value I can bring to the table. But in your case, 100% almost of that property, except for the land value when you bought it, maybe 10 or 20,000 bucks, is going to be taxed. So any amount you purchase with a 1031 exchange, let's say, for example, you only want to buy a $750,000 property in your example. You can do that. You would pay tax on just the $250,000 you didn't reinvest. But if you want to pay zero tax, you would need to buy something worth about $1 million. You could buy more than one property. You could buy a vacation property, some land. You could go from residential to commercial, commercial to residential. You can team up with another investor and buy tenants in common with them. There's so much you can do if you know how to do it and you're aware that it's possible. Sadly enough, like you mentioned, a lot of people find out about this so late in the game, after they have accepted the offer, after they're in escrow, and you have to do these transactions in a very timely fashion. You don't have much time to figure things out once you started the process. And it starts at the close of escrow, but we need to be involved before the close of escrow.
Got it. So I just wrote down a ton of things that I think are really important. Maybe some are things I'm still not sure of, but definitely things I think people really need to be aware of based on what you just said. So knowing that we could either go residential to commercial, commercial to residential. If I'm not mistaken, the one rule still is it cannot be for real estate you intend to live in correct yourself, right? You can't go out and buy yourself a $1 million mansion for your primary residence, or can you?
Well, since you brought it up, I'll say what the rules and laws are, but it's always supposed to be, and should be, your intent when you do a 1031 exchange to buy a piece of property to be held for investment or productive use in a trade or business. That property should be held for at least 2 years or 24 months. It can be less than 24 months, but we always like to discuss why you're selling it so quickly. What are you intending to do with it? But if you're going to if you think you might want to move into that property, then you'll want to wait the full 24 months as investment. After the 24 months, you're allowed to convert the property for personal use if you want to do so. So holding it for 24 months as investment, let's say 2 years later, you decide to retire and you decide, well, one of my investment properties located in the state that I want to retire in is already there. I can move into that property if I want to. It won't trigger a tax liability. What it will trigger, though, is it will create it to be a primary residence. It won't give you the same primary residence exclusion if you turn around and sell it. That won't help you. But if you want to live in that property as your retirement home, absolutely a masterfully great idea.
Well, thank you. You definitely just taught me something new. So I'm going to keep that in mind. And then I knew the part of you didn't have to spend the whole proceeds on an investment. You could keep some and pay the taxes. I knew that you could split it. What I'm still uncertain of, and hopefully you can shed some light for myself and others, is can you spend more than what you walked away from at closing? Let's say I have that $1 million and I want to buy a $2 million property.
As long as you spend all of the cash proceeds from the sale that we're holding for you, you can buy as big a property as you want. So that means you can get a much larger loan if you want to get a much larger loan. The reason I said it that way is that, let's say for your example, you have a $1 million sale with no debt on it, and you buy a $1.3 million property with the proceeds and get a $500,000 loan. Well, that would leave $300,000 in our exchange account. See, that would create a tax liability. But you could easily take that $1 million cash and buy how much ever you can leverage it out to if you wanted to. You could buy more than one property if you want to. So
Yeah, I mean, I guess technically if you use the standard 20% down conventional mortgage formula, you could spread that $1 million out over 5 different properties
or more.
or more, each valued at I'm not going to try to do math right now. It's a little late on a Friday, but yeah, hopefully people are getting the point of, leverage plus tax deferral equals incredible wealth building strategies.
Right. And over leverage, I'm not a big fan of, but I'm not afraid of it if the property's cash flowing properly. Absolutely.
Well, yes, and I'm so glad you said that, because some of us more experienced investors tend to be a little more aggressive than the general public should. Leverage is good, but use it carefully. Make sure your cash flowing, your debt service is there, and you're not taking on something where you can't sleep at night. And now you're like, I'm not going to sell it, and you will. Let me not speak for you. So if I did that, I over leveraged myself. I got myself in this situation, and I'm like, you know what? I want out. I'm going to sell this. I don't want to do it anymore. If I sell it before the 2 years, it all becomes fully taxable. Correct?
Well, actually, if you sell it at any time and don't do another 1031 exchange, then it could be taxable. So 5 years down the road, we're only deferring the tax. So the secret is to convert it. And again, this is very important to understand. Let's say, for example, you want to live in Daytona Beach, Florida. Well, you want to retire there. A lot of my investors say, I'm going to buy a property today in Daytona Beach, Florida, because I know if I wait 5 years to buy it, I probably may not be able to buy it at the time I want to retire. So they buy it today and rent it out and let it be used that way. Now, let's say they decide to sell that property at some point between they actually moved into it or converted it, then it would become taxable. But what's interesting, and I want to make sure they hear this, the problem is when you only own your primary residence, it goes up in value. If that's the only property you own, when you sell it, you have to live someplace. You have to take that money and buy something else. You think you made a lot of money, so what? So the other property you have to buy went up in value too. There's no way to win the game. You have to own at least 2 pieces of real estate to even start winning the game in real estate. Yes, you can make some money in real estate, but listen to this. I'll buy the property I may want to live in retirement. Guess what I get to sell if I move into that as my primary residence, where I can live for as long as I want. I can sell my current primary completely tax-free up to $500,000 in gain to me and my wife, plus what I paid for it. I don't have to reinvest it. I can use that money to pay off all my debt and have instant retirement. Just that simple little tweak in the way you're doing business. And you have to have 2 in order to do that, unfortunately. But I've never had many people complain about real estate, honestly, except for the fact that tenant might be kind of nasty every once in a while. So what? Stock market could be nasty too.
Yeah. And you have more control of your real estate generally than you do of the stock market.
And there's so many more tax benefits. You and I both know, owning in real estate, the tax benefits just by owning it are massive. And it's part of the deal. People call me a loophole. I'm not a loophole. I'm tax law. I've been around for over 100 years, and I've been doing it for 22 of those 100. And I've exchanged billions upon billions of dollars, saving hundreds upon hundreds of millions of dollars in taxes for our clients. And I'm currently working on 3rd generation money for some of my clients. And to watch how much that money grew, tax deferred, it is crazy incredible the lives that we've been able to change. But it takes time, a little bit of patience. In the stock market, I see people make money in stocks, but not like that. Never like that.
Not unless it's in a qualified account. And even then you have limits on what you can contribute and how much you can.
And you can't leverage it. You can't do anything.
Yep.
You can buy real estate with your IRAs and such if you do it. I love that too. But again,
I just started doing that myself recently. It's
another
fantastic.
conversation.
Totally separate conversation. That's the whole self-directed podcast that we'll have at some point in the future. I want to check one more thing with you, and I'm pretty sure the answer is yes, but again, you're the expert, not I. So you cleared up that we can spend more than we have in the exchange account. We can don't have to spend it all, but we have to pay taxes. We can take mortgages. Let's say in that example you just gave of the person who sells their primary residence, let's say I don't want to take a mortgage. Let's say I still have that same $1 million profit from my investment, and I want to buy a $1.5 million house. Can I commingle $500,000 of my own money for that purchase?
Real quick, I want to make sure, because I heard it's being recorded. I'll make sure it's clear. You mentioned primary residence. So we talked about an investment property or a primary?
You know what? Let's take that out of the equation completely for simplicity. Let's say I have $500,000 sitting in my bank account.
Okay.
And I get that same $1 million from my investment property that we've been using this whole time. You're going to be my 1031 specialist. And I say, Doug, I want to buy this $1.5 million mansion. $1 million from the 1031. I'm going to put in the 500 that's in my bank account. Would that,
You can
would that be
always
possible?
do that.
You
You
can.
can always do that. But here's the interesting thing. Another thing a lot of your clients don't understand, sometimes they have debt on the one they're selling. Let's say, for example, they have a $500,000 mortgage and you got $1 million sale, okay? And when you buy the new property, the way the 1031 works is you got to buy $1 million worth of real estate. That means you're going to have to replace that debt or bring extra cash to the table to match that debt to make $1 million purchase. Well, a lot of clients don't sell that property because they got a 2.5% mortgage on it, and they're going to have to replace it at 8.5%, right? At today's market. But what's interesting is that 2.5% loan is killing a lot of my clients. The reason being, they're holding on to an old beat up property that's costing them more money to maintain than they're making on the property at whole. You can always bring in cash that equals the debt that's paid off to make it a debt-free purchase, even though you had debt. Because you read on the internet, it says you got to replace the cash, pay all the cash, and you got to replace the debt. You don't have to replace the debt. You have to replace the value of the debt in the 1031 exchange. I know it's a little long-haired and harebrained for the clients listening for a quick talk, but always talk to someone like myself or you before you list the property for sale. Get the facts before you pay the tax or get yourself in a situation that you could otherwise avoid it.
Well, and thank you for saying that, because I'm going to throw out another disclaimer. This is not meant to be a comprehensive. By the time you're done listening to this episode, you're going to be a 1031 master. There is so much more that goes into it than what we can cover in hours on a podcast.
It's taken me a long time to figure this stuff out, and every day I get challenged. And I invite the challenges because it makes my day interesting. So
I love it. One thing I think is important, and we don't have to go into all the different facets of it, but I think it's important people realize that there are time frames involved here, right? You can't just take all the time in the world to say, well, I'm working on a 1031 exchange, so Doug's holding my money, we're good.
Right. No, and I'm glad you brought that up because I didn't know how much time we're going to have. When you do a 1031 exchange, we need to be involved before you close escrow. But once you close escrow, it starts two very important clocks that have to be adhered to by the IRS ruling. One is you will have only 180 calendar days to buy something or multiple properties, whatever you're going to buy, and close on them before the 180th calendar day from the day you sell the property you sold. Now, the other time frame, the harder one, is by the 45th calendar day after you close, you have to let us, the qualified intermediary, know in writing what property or properties you're interested in for the exchange to be used to purchase. Here's the catch. After the 45th day, that list of properties you give us become the only ones eligible going forward for the exchange. You can't change that list of properties. And
You
can't just do something like that. Yeah, so that's that's called the 45-day ID. And again, it's something that you don't have to have offers on the property you identify. They don't even have to be listed for sale. And you don't have to buy traditional real estate. You could buy DSTs, oil and gas, oil rights, wind rights, all kinds of different things we can buy. But traditionally speaking, residential and commercial real estate, the actual physical asset, are typically the best things to buy.
Got it. Now, question on that 45-day, I'm going to call it the short list. Does it have to be a short list, or can I just say, you know what, I'm going to cover all my bases because I know I'm not going to get another opportunity and put 100 different properties on there? Is that acceptable?
So let me go over the 3 different ways to do it so we know. The most effective, if you're only going to buy one piece of real estate, let's say in our example, $1 million for your deal, that's 100% of what you need to buy. You'll want to limit your number of properties to 3 or less. That's called the 3 property rule. You can identify 3 properties of any value anywhere in the country. You could take that $1 million and buy $100 million if you want to in that example. But if you identify more than 3 properties, you can do that. But you're going to be capped at 200% of what you sold cumulative value if you do that. So in your case, for the $1 million, maybe you want to buy 4 $250,000 houses, right? Or maybe you want to leverage it up a little bit. Well, you only can identify 200% of what you sold if you do more than 3 properties. So you're limited to $2 million in that transaction. But you can identify more than 3. Now, here's the next piece. If you're selling a portfolio, more than 3 properties, you can do that, and you can purchase a portfolio with more than 3 properties, and you can exceed 200% because a portfolio is going to close the same day. Here's the catch. If you identify more than 3 and 4 or more, and the value of all those properties exceed 200% of what you sold, $2 million or more, you can do that, but you're going to have to purchase 95% of what's on that list or the whole thing fails. It's called the 95% acceptance. Sounds hairy, sounds crazy, but that's for portfolios. So to make clear, if you're buying one and you're buying one, selling one and buying one, the 3 property rule works best. If you're selling a big one and you're buying a bunch of small ones, the 200% rule works best. And portfolios is a 95% acceptance.
Wow, I am so glad I asked that question, because that is definitely something to keep in mind. It's because clearly there's a benefit to identifying as many as possible, but there is also a drawback to now you're gonna have to buy them. 95%.
And this is the question I ask. May I ask the question of all the investors listening to make a 1031 exchange not so grueling? Before you list the property for sale, get with you or get with me and ask yourself this question. If there were no taxes, there were no rules, and I could do what I want with the money, what do I truly and honestly want to see it do? And come to me with that question, and we'll talk about how the 1031 exchange can help with all or some of the taxes, helping you get to that goal. Because what so many people do is they try to say, okay, I'm going to keep it to 3 properties. I'm going to do 200%. I'm going to do this, that, and the other. And they let the tax tail wag their dog. And that's not the way you do business. Sometimes it's okay to pay a little tax. I'm not afraid of that. So,
that statement reminds me of your previous example of the person who's holding the dog of an investment because it has a 2.5% interest rate.
yeah.
Right? Some people get fixated on the wrong thing. Yeah, interest rate, you want a low interest rate. Yeah, you don't want to pay taxes, but at the end of the day, are the cons outweighing the pros?
Right. And even so, I had several of my clients already this year with this high interest rate environment, net cash flow better with a 7% mortgage than they did with a 3. Imagine that.
Right. As you mentioned earlier, maintenance, upkeep, all of those kind of soft and phantom costs will eat away at your cash flow before you even know it.
And being as active as you are, opportunity costs. They come and they go.
Yeah. And in hindsight, hindsight's 2020, but you never get rid of that regret.
No. Regret's a bad thing.
All right, no pun intended here, but I'm going to ask the $1 million question that's been on my mind. And if nothing else comes to mind, I'll let you go there, because I want people to really, again, not think they're getting the whole story here. I want them to contact you. I want them to really run their specific scenario by you, rather than think they have it all figured out. But sure. I'm putting myself in a position of someone who just sold $1 million property. There's $1 million sitting there waiting for me, right? Like, there's so many things I could do with that $1 million, but I'd have to pay tax. Doug, if I roll all of that million into a 1031, am I allowed to cash out, refinance the property after I close to recoup some of my cash for my own personal purposes?
You're reading my mind, because when I started doing this 22 years ago, the internet wasn't around. And people would call me before they sold and said, my CPA, my advisor, my agent told me I got to do this thing called a 1031. Can you help me? Today, they come to me with their cell phone in their hand saying, I've done all my research, Doug. I'm ready to go. Let's go. Well, sadly, the internet is not a good place to start. It's a horrible place to start. To answer your question, if you read on the internet, it says you cannot refinance before or after an exchange during the same calendar year, or it should be at least 1 year away from the exchange, to avoid paying tax on the IRS saying you intended to do that and you just delayed paying taxes. So to avoid that, here's how it really truly works. If you want to refinance the property right after you sold it or bought it with a 1031 exchange and get cash out of it, you can do that as long as there's a business purpose for that cash out. In other words, you're buying another piece of real estate, starting a business, investing the money in a business. You can't cash out just to put the money in your bank account for at least 1 year after the sale of, or when you purchase that new property with a 1031. But you can after a year with safety. Your accountant's the best one to talk to about that, to make sure they're comfortable. Because some accountants say just the next tax year. I happen to be very conservative. I like to say the next tax year and 1 year of time. So I speak conservatively. So.
Got it. So I'm just going to throw this out there, even though I know you just said go to the accountant, because I have a banking background as well, and I'm wondering, is a line of credit off the equity in the property considered the same thing as a refinance?
Perfect. Is it the one you're selling or the one you're buying?
1 year of selling.
Okay. So let's do the first one, that you're selling a property you have a line of credit on and you need to fix the property up.
Oh no,
You
I'm
could
sorry.
take that.
Let me rephrase. Let me rephrase it. So the new
Okay.
property that I bought with my 1031 funds,
Yep.
instead of refinancing it, because I'm not going to use it for a business purpose and I don't want to wait the year, can I get
Okay.
away with taking a line of credit on it instead?
Perfect. Again, if you pull money out of the transaction, you're going to deposit it in a bank account someplace. If that money is to be used personally to pay off credit cards, go on vacation, have fun, you could be very well subject to tax on that. So if you put the money back into the property to fix it up, to put granite countertops in or whatever yourself, that's perfectly fine as well. But the money has to be reinvested when you pull it out. Okay. If you also want to pull the money out like that and you're okay with the subject to tax, please talk to me. There are other strategies that I use routinely to help clients offset the liabilities they create for doing these things. And sometimes it makes a lot of sense to do just that. So again, if each person's a little bit different and each situation is always different. And unfortunately, what I say and they oftentimes hear are two different things. So it needs to be a conversation had when you're not stressed out and you have time to think about it, and not at the closing table. So it's the best way to do it.
Yeah, I'm so glad you said that, because it's not just stress, emotion. Can
Emotion.
get the best of people, whether it's excitement, joy. It's like you just told your girlfriend or your husband or your wife that we just sold $1 million property, and they're like, so we could take that vacation to Aruba now. And you're like, oh no, I'm rolling it over. And then you go and do something silly without consulting with someone like yourself. You refinance it, you pull it out in a line of credit, and you go and put it in your bank account thinking, how's anyone ever going to know? Well, they're the IRS.
And I answer that question again. I need your audience to hear this. If your wife or spouse wants to go on a vacation and you haven't been on one, you need one. Take the damn money, pay the tax on it, and go have some fun. It's okay to pay a little tax, man. I got to tell you.
Or back to your original advice, go talk to your accountant about what your tax liabilities are for the year, how much you could take out safely without bumping yourself into the next tax bracket, and just plan with a little bit of strategic foresight instead of letting those emotions dictate the decision.
Correct. And also to remember one thing very important: capital losses offset capital gains. If you have, for example, a stock that got hurt and you're down 20 grand on it, sell it, take the loss, and take 20,000 gains from the sale. They wash each other out. Wait 31 days if you love the stock. You have to wait 31 days to buy it back. It's called a wash sale. You can still own the stock, you just can't own it for 31 days. And again, maybe you're carrying business losses. Maybe you got something going on. That's why I want to talk to clients before they list the property for sale, so they know exactly what they're doing. And let me give a fun story real quick. Not that I work with just people that are rich, and not that people are destitute, but I like to help people that they have a piece of real estate and they're a little bit broke because they're in retirement, and they found out that retirement gets expensive as hell. Well, they're selling a piece of investment real estate. They don't want to pay the taxes, so they want to remain poor or cash broke and do a 1031. I say no. If you're cash poor, that means your income's low. How bad is your income? A married couple with less than, I think it's $93,000 of income this year, their capital gains rate is zero, up to $93,000. So let's say they made $50,000 that year they sold the property. I would tell them all day long to talk to their accountant, see if it's okay if I give you $43,000 from this transaction to put in your bank at a zero tax rate. Why not? It'll help. But then I ask that same client the next question: is $43,000 enough? What do you need to do? I would like to have a new car. Then take 50 and pay tax on 10. It's okay to pay a little tax. So again, my job is to make it very painless and to make it as best as possible to move down that road. Because I gotta tell you, it's a very, very fine line we operate on, you and I. You know, our job, I can see your passion. It's the same as mine. And our job, if they didn't have problems, we wouldn't have a job. And not that I can fix everything, but if you give me time, I can dent the heck out of just about everything. So
I love it. It reminds me of kind of an example I use with people, because I love Google. I think Google is one of the greatest things on earth, but it's also one of the worst things on earth. Like WebMD. Okay, it's great to kind of get an idea of what's wrong with you, but if you stay on there long enough, you have cancer. There's no question about it. If you keep diving deep enough on specialized real estate transactions like 1031s or even the self-directed IRA, it took me years years before I made the move because I just didn't feel like I understood it well enough. You've got to consult with very specific advisors and don't trust what the internet says, because in a court of law or against the IRS, Google told me does not wash away your tax bill.
No, stupidity's never, they don't go with it. Also, since we probably won't have a chance to talk before the end of the year again, at least to some of these clients, if any of your clients or people listening to this podcast are considering selling a property, but they want to wait until January to do it so they take a tax hit next year versus this year, there's a lot of reasons we do that. If they close the property after November 18th of this year, November 18th till December 31st, I can take the tax liability in most cases and shift it to 2024 for them if they want to go ahead and sell this year. Because what I don't want them to do is to wait to lose an opportunity. If they have someone willing to pay more than their property's worth or a great price for it, I don't want them having to wait till January to sell the property. Sell it now. We'll use the exchange to straddle the tax year.
And you know what, from a calendar perspective, you mentioning that today on October 6th is quite fitting, because if you list if you go into contract today, likely you will not close until November 18th-ish.
That's why I bring it up. This is my favorite time of year. I am very busy from November 18th until December 31st. And sadly enough, on December 31st, a lot of my clients call me up and say, I was going to sell, but my accountant just told me yesterday, the day before the banks closed and everything else, that I can move this over to next year doing a 1031 because it's too late. And if they haven't closed, they're closing. Usually it's weird. They close the last business day of the year this year because one party wanted to happen this year. They want it to be next year, right? Well, that's for the tax tail wag your dog, obviously, but you're selling a property the buyer wants to close this year. You're saying no to that buyer because you want the tax liability next year. No. Take your buyer. Let's do an exchange. I'll drop it into next year for you.
That is incredible. Doug, I've learned so much. Please tell everyone how they can contact you, website, phone, email, whatever the best way to get in touch with you is, so they can make sure they're taking the proper steps before getting to that closing table.
You got it. And always they can contact you if they should lose my name and number, obviously, because you'll have me. But the best way to reach me is by phone and email, believe it or not. My email is doug.blackwell@BEA1031.com. My company is Blackwell Equity Advisors and 1031 Exchange. And my cell phone number is 480-851-9557. You can also visit my website at www.BEA1031.com. Look forward to hearing from everybody. And I appreciate you letting me be on your podcast today.
Oh, absolutely. I really appreciate you being here. I truly could not think of a better way to wrap up my week than, because I try to take it easy on the weekend. So all of this is just going to percolate. But yes, everyone listening, please, if you have any questions, if you've been thinking of selling a property, reach out to Doug. Get your ducks in a row early. It's no fun scrambling, letting those emotions take over in the 11th hour when it's like, oh no, I've got a problem. And we are coming into that time of year. So if you, all of Doug's information will be in the show notes. But please, if you can't find it or for whatever reason, definitely always reach out to me, Matt, M-A-T-T @timeawaygroup.com. Happy to connect you with whoever you need. And Doug, thank you once again for being here. It was an absolute pleasure.
Have a great weekend.
You too.